Hello friends, a very warm welcome to my channel. In today's video, we are going to talk about a company called Ganesha Ecosphere. So this company works in the recycled sector. They recycle plastic waste products like PET bottles and make yarns, filaments and textile items from that. So recycling is a very big thing which is going to continue for decades in India as well as across the world. And this is one of the largest PET recycling companies in India. So if you're new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos that I upload. And if you're not a part of our Telegram channel yet, do join today by clicking the link in the description so that you join the correct Telegram channel. Every day before the market opens, I share my views on the market and I also share my portfolio allocation strategies which will improve your returns. So let's begin the analysis of Ganesha Ecosphere. This will be the flow of our discussion. We'll talk about the business model of the company in brief. We'll look at the stock performance in the last 3-4 years. We'll see the main financial parameters. We'll talk about what led to the rally in the stock. We'll discuss what is the outlook of the management going forward. We'll talk about the present valuations. We'll understand the risks of investing in this company and then form an overall view. So Ganesha Ecosphere started in 1987. They manufacture recycled polyester staple fibers. So in this value chain, what happens is the waste bottles and other plastic materials which we discard in daily life, those are picked up, those are sorted, made into flakes, and that is used as a raw material to make the other products which this company manufactures like dyed yarns, recycled spun yarns, rPET chips, PET granules, rPET filament yarns, and these products are further used to make the end products which we use in daily life. So this company is into a B2B business. They procure the waste plastic material, wash it, sort it and process into these kind of materials. These materials are further used by another company which is making plastic products, and those products we use in daily life. So this is a B2B business. In terms of capacity, this is one of the largest in the PET recycling space in India. They recycle almost 150,000 metric tons per annum waste. In terms of capacity, they have 196,440 tons per year and they have a very strong collection network. In terms of organization structure, Ganesha Ecosphere has 3 subsidiaries, Ganesha Ecopet and Ganesha Ecotech Private Limited. These 2 subsidiaries have started a new manufacturing plant in Warangal, and the other wholly owned subsidiary which is Ganesha Overseas Private Limited. This subsidiary was formed to carry on operations in Nepal. So altogether this company has around 6 manufacturing units across India as well as in Nepal. In terms of products, they have more than 500 product variants, more than 400 B2B customers in India, more than 300 suppliers in India and 6 manufacturing plants as we have discussed. Roughly about 2,800 people work for this company. Now if you look at the stock performance up to COVID, the stock was giving a steady rise or kind of consolidating, but post-COVID, this sector came into the limelight. There was government's focus on this sector. A lot of multinational companies wanted to use the recycled plastic, and there was a high demand in this sector which led to good growth in this company. And that's why the stock rallied almost up to 2,500 and now it is consolidating at somewhere around 2,000 levels. So the stock has turned out to be a very good investment for its shareholders. If you look at the financials, the revenue has shown a steady uptrend in the last 5 years. It was about 750 crores in FY21, which rose to almost 1,300 crores in trailing 12 months. There was a small dip in revenue in FY24. EBITDA was also showing a good trend. It was around 85 crores in FY21 and in the trailing 12 months it's about 190 crores, which is almost double. We also see margin improvement in their business. Earlier the EBITDA was around 11% and now it is about 14%. And going forward with the new products which the company is manufacturing, the rPET granules in the Warangal plant have an EBITDA of 22%. So overall we can further see a rise in EBITDA going forward up to 16% is the guidance of the company. In terms of debt, the company has less than 500 crores debt right now, and going forward, in spite of doing such high capex, the company plans to maintain a net debt of highest 500 crores is their outer margin. The return ratios are less because the company is undergoing capex even now, but this can further improve a bit as the utilization improves. The promoter holding is just about 35-36%. This can restrain the capital raising capacity of the company because the promoters have to further dilute if they don't contribute an equivalent amount in the further fundraising. It's a high inventory business of about 5 months, and this metric is something which we have to monitor going forward. Now, what led to the sharp rise in the share price in the last 3 years? There was a steady growth in revenue marked by margin expansion which was done by the company. And as this sector came into the limelight, the PE got re-rated. So this was a perfect recipe of a multi-bagger which we observed in the stock. Now, what is the growth outlook of the management going forward? The third production line of rPET granules has come into production now. And they've onboarded 2 new brands for buying these rPET granules. Overall, their capacity of rPET granules is utilized around 70% now, and there is further being expanded. In fact, for the next 12 months, their capacities are fully booked. They are coming up with a new unit in Odisha by investing 450 crores with a capacity of almost 45,000 tons per annum. This is almost double than the existing capacity of rPET granules. So the segment which is related to rPET granules has been functioning very well, but there is a slowdown seen in the yarn business. Recently, the company has done a couple of partnerships. They've invested about 16 crore in Race Eco, which is also a company in the same recycling space, so that they can procure raw materials seamlessly from that company. They've also done a joint venture with the same company so that they can set up a washing unit for the plastic flakes. They want to focus on high value products so that they can increase the margins of the company. The Warangal project, as we have discussed, is a higher EBITDA project of 22%, which will lead to further margin expansion in the overall capacity of the company. They want to focus on exports, so whenever the domestic demand is weak, they can balance it by exporting. They've also done the same in the present year. That's why the results are steady. And in terms of top line growth, they expect to do about 1500 to 1600 crores in FY25 with an EBITDA margin of around 15%. And thereafter, from FY26 onwards, you can expect a growth of about 25 to 30% for the next 2-3 years. So the growth visibility of the company looks quite strong. In terms of valuations, it is trading at somewhere around 60 times earnings right now and price to book of 4.7x. And market cap to sales of 4x. So in terms of valuations, it is slightly expensive compared to the sector which operates in, as this is not something which has a very high moat. But as this theme is into the limelight, these kind of companies are getting slightly higher multiple than before. Now, what is the risk of investing in this business? There is raw material price fluctuation which impacts the margins of this business. There is a slowdown in some products in terms of demand. From China, there are products which are dumped into India which impacts the business of this company. A lot of government regulations are involved in the recycling space which can impact the business of the company. There are certain other companies in this group which are doing similar business, although the company is trying to clarify that there is no overlapping in the business, but still that is a gray area which we have to closely look at or monitor going forward as investors. And in terms of competition, there would be more companies coming into this space, as in the earnings call also the company has mentioned. For yarns and filaments, there are certain excess capacities already in India. So there could be competition risk going forward also. So now that you've understood the business of the company, you've looked at the financials, you've understood the outlook of the management going forward, the risks, the valuations, what is our overall view on the company? So there is clear visibility of growth in the company for the next couple of years at least. There are new capacities coming in. There is scope for further margin expansion and a steady revenue growth of 25-30%. The future of the company looks very bright. But in terms of valuations, it is not a stock which is very cheap and may not be very suitable for somebody who is a pure value investor who prefers to buy stocks at undervalued prices. But if you are an aggressive investor who wants to take some risk, who wants to be invested in the recycled theme, you can think of gradual accumulation in the stock over a longer period of time, as in when you see the weakness in the market. So that's about Ganesha Ecosphere. I hope you like the crisp video. I've tried to cover all the important points in this video. If you like it, hit the like button and subscribe to the channel. Please do share it with your friends on WhatsApp. Do join a Telegram channel by clicking the link in the description button, and also leave your suggestions for the upcoming videos in the comment section. Thank you for watching and have a wonderful day.